Eventually, this all backs up on mom and pop in terms of the mortgages. And the truth is, the Fed has literally proved that it has no reason to exist. Well, in that summary, I wrote 53 reasons why the Federal Reserve should be closed.
Under what circumstances would you recommend someone were to refinance their mortgage? Welcome back to Real Estate Mindset. Is there a stock market sell-off going on right now? And by the way, you guys, happy Monday, or is it just the year-end normal sell-off? So we're going to go into that. We're going to show you guys proof positive how the Federal Reserve has lost control, and actually has lost control for quite some time. And then we're also going to go into the housing market, guys, in the area of the housing market that we're going to cover today, which goes into the Fed losing control, is the fact that residential mortgage rates have absolutely skyrocketed immediately after the Federal Reserve started cutting the federal funds rate. And don't worry, you guys, we're going to have everything broken down extremely thoroughly, and everything is going to be chaptered. And we have read your comments. We're going to stick with this theme where Mitch and I are talking about both the economy and the housing markets. Everything will be chaptered. So if you don't have an hour or however long this is to watch the video, just come back when you have time and go to the chapter in the area that you want to learn more about. So thank you guys for joining us. And Mitch Vexler, happy Monday and New Year's Eve. How are you, sir?
Good. It's been a long last 5 or 6 days, kind of losing track a little bit, but there's a lot to go through here, and there's a lot of things happening.
Yeah, I thought it was Thursday, but it's not Thursday, it's Monday. My God, we have a lot to cover. And before we really dig in, Mitch, I want you to kind of set the tone for the theme of this video and talk to the viewers about the email that you sent me about an hour ago. You guys, Mitch sent an email to me because he actually read not one, but 2 Zero Hedge articles that didn't offer a solution to anything. And we're missing a large part of the story. Mitch, can you go into that before we jump into the stock market?
Yes, there was 2 articles, one of which is called No Easy Fix for Housing, and the other one is U.S. Homeless Epidemic Spikes. Well, they're nice stories, but everything we have tried to do since I've been involved with Travis is not give anybody a story. We look for the facts, and you can't just claim a story. These are independent reporters. They don't even know each other. So they laid out the story, but they didn't go backwards to determine what caused the story. What is the root cause of the problem? Nor did they go forward to say, here's a possible solution. And that is a bit of a problem. And that's what's happening in the press generally, which is they make a story. In reality, the story ends up pitting people against each other because the solution isn't on the table, and neither is the root cause. So to that point, with regard to the real estate property taxes, I've got well over 10,000 hours in documenting the facts and documenting the law over and above doing these videos and making the presentations necessary to inform mom and pop. And what we're about to get into with regard to the Federal Reserve, by the time everybody that's watching this video actually reads any portion of the 112 pages, you will know more than every employee at the Federal Reserve. So we'll talk about that shortly. The point that I wanted to start this with is you have to have denoting what the problem is, you have to have the root cause of the problem, and you have to have the solutions or possible solutions to the problem. And I think that's where we're going to head in this video.
And you also, should I say, quantified it by suggesting that roughly 66% of the reality of the true story, the way stories deserve to be told, is missing. And as a result of roughly 66% of the story missing to the general public, I mean, the apathy is going to grow, the confusion is going to grow, the division is going to grow. Is that correct, Mitch?
Yes. So if you just think of it simplistically, there's 3 elements that have to be discovered. 2 out of the 3, be it 66%, aren't even discussed. And to that point, the antidote for the 2 documents that Zero Hedge produced this morning, the antidote just happens to be the elimination of the real estate taxes in favor of the uniform states sales tax. That's a big deal because that will return the balance sheet to mom and pop where the equity is currently being stripped. And that is the problem. That shows the real problem of just telling a story. It's not enough. The investigative reporters have got to do their job. Otherwise, they're as useless as the government that's feeding the information to them. And that's the problem.
So we're going to go over the stock market now. In order to go over the stock market, let me show you guys a couple things that are going on with the stock market and what some of these brokers may be looking at, starting with this first thing right here, which is your 5-year break-even inflation rate. Remember, the Fed's been telling us, well, they told us that inflation is essentially transitory. They were wrong, deadly wrong, actually, about that. And they've also said that their goal is a 2% inflation rate. And I want to remind you guys that that goal is going bye-bye. And right now, the market expects inflation 5 years from now, okay, this is a 5-year break even, to be 2.38%. Essentially what we saw here as of about August, or rather when they started reducing interest rates, literally when they started reducing interest rates, the inflation expectations shot up. This is showing us that it has jumped up all the way to 2.38%. So in an event, and this is why I'm showing you guys this, where we have deflation, which is prices going down, that can happen at the same time, and probably will happen at the same time, where money and the dollar continues to lose its purchasing power. And we see that in this inflation rate. The market expects inflation to stay. I also wanted to show you guys the overnight reverse repo market. So this is kind of like excess money, if you will, or the suspension system of the economy. And the good news is December 20th, this actually went down to 98 billion. So almost out. That's great. But recently it has gone up, probably because of year end, not 100% sure, but the reverse repo market is sitting at $268 billion. In essence, guys, banks, they still have monopoly money to screw with us. And you still see that even though this is low, there's still money there. Now, we're also going to revisit the 10 and the 2 inversion. This is an economic indicator of a recession. This is generally the most widely used indicator because this right here encompasses multiple data sets. And what I wanted to show you guys is we've been uninverted since about August 28th of 2024. So generally, and let me make a wider spread of this map here. Generally, when the yields are inverted and they uninvert, it's about 6 to 8 months before we enter recession. You see that here, the uninversion, and then 6 to 8 months recession. Same thing here, uninversion, and then recession, uninversion, recession. So I'm bringing that up because if we are to use the history and the math, that means that the recession will probably start. First of all, they manipulated data. But if we're to review this data and say that this is accurate, which it's not, that means that the recession will probably start, if we only look at this, the first, possibly second quarter of 2025. Here's the Dow Jones, and this is over a 6-month period of time. Today, the Dow's down 280 or 0.65%. And what I want to show you guys is it's kind of clear by now that the stock market peaked at the beginning of December. Okay, I'm going to show you guys also the S&P and the NASDAQ, but right now the Dow Jones has essentially been going down for, 3 weeks in a row. Kind of went up and rallied here, but it's down again. And I'll ask Mitch whether or not that's just a year-end sell-off. The S&P hasn't had a decline like the Dow, but nevertheless, you guys, it also peaked right about here. You guys see that as well in December right here. So beginning of December, and since it has gone down slightly. When it comes to the NASDAQ, here's the 6-month as well. Same thing as the S&P. NASDAQ peaked in December, mid-December for the NASDAQ, and it has been slightly down since. Today, it's down 142 points. One thing I forgot to point out, Mitch, is on that 5-year break even. Prior to COVID, for the last decade, inflation expectations for 5 years has been well under 2%. So the Fed appears to have basically been struggling and even giving up on certain inflation expectations. And I know the expectations of the market is important to the Fed. But my question to you, Mitch, given all that stuff that's going on, all of the warnings that we've been giving for the last 4 to 5 months, can you explain to the viewers what the heck, I'll use the H word here, what the heck is happening in the stock market? What's next? And is all we're saying just a year-end sell-off? Or is there something more at play here?
The stock market is somewhat independent of what the Fed is doing. So let's back up for a second. The document that'll appear below this video is called the Fed Analysis. It's 112 pages. And I don't expect everybody to read 112 pages, although it is a fantastic read. What I do expect is that if you're interested, go to page 101 and you will see the summary of all the evidence that's in that document. Well, Travis hit on something a minute ago, talking about the idea of a recession and that the government is saying we're not in a recession. And there's an extraordinarily high probability, due to the fact that the data is always revised, that we are, in fact, in a recession. It will be revised to prove that we are in a recession. How can anybody with a brain cell say that we're not in a recession, given the employment that we just documented in the last video, that the unemployment is climbing, the inflation is climbing, the producer price index, the ability to produce products, goods and services, is decreasing. Now, the new administration may be able to bump that a little bit, but they've got a huge tail problem. So the point is, you've got data being revised, unemployment going down. The data itself, through the press, is completely manipulated. And inside that document, 112 pages, starting at page 110, when you get down to, I think it's page 111, you will see something called CPI, the big lie. And in truth, that's the ultimate big lie. The data has been created recently such that it's missing information on purpose, by intent. Do you know that your cost of fuel is no longer in CPI? Do you know that your cost of food is no longer in CPI? Well, that means that what is being produced by the government is a straight up fraud. It isn't true. The data has been manipulated. That is completely bifurcated from what the stock market is doing. Although, if you look at the last week, you'll say the stock market is beginning to get jittery, which it is. And that's just in the form because we're so high in terms of what the market is doing. So it comes into technicals. And so far, I've been pretty accurate as to what was happening, when it was going to break, and it has done so. But the system isn't broken. We're only down a little bit from its all-time high. But the manipulation of the data is what is going to cause more stress. That is what is going to cause the VIX to run. That's the volatility index. And eventually this all backs up on mom and pop in terms of the mortgages. And the truth is, the Fed has literally proved that it has no reason to exist. Well, in that summary, I wrote 53 reasons why the Federal Reserve should be closed. And everything that Travis just mentioned with regard to the CPI goes right to the top of the list. It's the CP index, consumer price index, but it is manipulated. It in and of itself is the big lie. That is how the Fed has equity stripped mom and pop, in addition to the central appraisal districts equity stripping mom and pop. You've got two entities, and that's what the beauty of this document. I literally have tied the structural setup of the Federal Reserve to that of the central appraisal districts across the United States and the taxing entities. Their actions, their legal structures are identical. They are truly correlated. They are truly committing fraud on a mass scale. That's what's in the document. You don't have to read the whole thing. Just read the last 10, 11 pages. You'll get it.
Yeah. And Mitch, I'm going to go in for the viewers as well. In the next segment where we go into the Federal Reserve losing control, I'll go over that document in more detail. It's going to be linked in this description. Mitch, is it fair to say that, because inflation is devaluing the dollar, is it fair to say that dollar devaluation can and probably will happen at the same time as mom and pop continues to go bankrupt?
Yes, employment is going down. And yes, dollar devaluation, even though you would look at the charts and say, well, the US dollar is doing well at the moment. Yes, as I said before, we are the bad child on a really bad block. So the net result is, look, your purchasing power, we've got that documented in this Fed analysis. It's extremely well documented, to the point where if you run the math, your purchasing power is down 3,087 some odd percent since it was being tracked initially. So that goes back to roughly 1913. You look at your purchasing power of the dollar, we've got the graphs built into this document. It's irrefutable. The purchasing power of the US dollar is down roughly 97% since its creation. So when you understand what's going on, what makes anybody think that this isn't going to stop as long as the Federal Reserve exists? They're
I don't
not
think
there
they're
for the
thinking.
benefit of mom and pop. They're there for the benefit of the banks. And therein lies the problem. You've got 700 banks, give or take, right now today that have no business existing. They're bankrupt. Well, do you know that a couple of years ago, the federal government came up and said, well, we're going to have a bail-in program. We're going to authorize the banks, instead of us, the Federal Reserve, coming to the rescue, let the depositors become the rescue. Well, that means that the bank can seize your money. If you're in one of those weak banks, if you're unfortunate enough to be in one of those weak banks, those banks can seize your money and give you back a share in a bankrupt bank that literally isn't worth toilet paper. So you see, these things are tied at the hip. It's another element of equity stripping.
Mitch, that was for our next segment. I love you, man, so much. I mean, you want to rip their heads off, but we're gonna cover that. But I want to ask you this as well. Mitch,
Sorry.
reverse. No, you're good. Here's my question, Mitch, as well. I want to stay in this segment. I want to ask you something else. As far as the reverse repo market, it's losing money, but there's still money there. Do you think that there would be any money left in the reverse repo market had it not been for the Federal Reserve's creating in March of 2023 the Bank Term Funding Program? And real quick for the viewers, remember, you guys, we had experienced deflation in the housing market, and 3 bank runs. 2 of them were the second and third largest in the nation ever. And over the weekend, the Federal Reserve, and I think this is illegal, started doing quantitative easing, which is called, or a bank bailout, which was called the Bank Term Funding Program. That set into motion a reversal of all of the data points I was watching that showed deflation minus cars, used cars. Mitch, tell me what your thoughts are. If there was no creation of Bank Term Funding Program, would there even be any money in the reverse repo market, do you think?
Well, they create these things in order to pick winners and losers. And as we've said in the past, therein lies the huge problem. You're picking winners and losers that, in fact, should have been losers. These banks, whoever they happen to be, made economic decisions that were the wrong decisions. They deserve to go bankrupt. They deserve to be wiped off the face of the earth. That is called business. If you make an economic decision and you made the wrong decision, you lose. The idea that it should be put on the backs of mom and pop, because that, in essence, what has happened. Mom and pop has been equity stripped in order for the reverse repo market to exist, right? The federal government, let's call it the Fed itself, Federal Reserve, is taking money in the form of US treasuries, mortgage-backed securities that are on their books to help create the reverse repo market. The reverse repo market is a mechanism to shove money into the balance sheets temporarily on a cash basis of the banks so that they can keep the lights on. It's paying the banks to hold the treasuries. That's what it's doing. What other business do you know on the planet that can accomplish that task? The answer is none. Therefore, the Federal Reserve exists for the benefit of the banks, not for the benefit of mom and pop. And that is exactly what I've spelled out in 112 pages. But again, read the summary. The summary's got the 53 points as to why the Federal Reserve should be shut down.
Well said, sir, and great insights. Let's move on to the second segment, and let's talk about how the Federal Reserve has lost control. They put a bet out there, they failed, and we lost before they lost. Obviously, mom and pop has lost, but let me show the viewers, and let's talk now about the Federal Reserve has, in fact, lost control of the market. Let me show you guys. Let's start with taking a look at the federal funds rate. The federal funds rate, you guys, is right here. You guys can see right now it's, and this is according to Fred Economic Data, by the way. This will be linked in the description, or you can just type it in Google. But right now, this is saying the federal funds rate was 4.64%. Now, the first, and this is monthly, you guys, so the first cut started happening in September. You see that right here. So in September, I want you guys to remember this. In September 2024, the Federal Reserve started cutting rates. They cut the federal funds rate by 50 basis points. Remember, you guys, that started in September. So the Federal Reserve is lowering the cost of borrowing money. Now, at the same time, that they started cutting the federal funds rate, 30-year mortgage rates started absolutely exploding. And they have been skyrocketing this whole time. And I'm going to go into that a little bit more again when we go to the mortgage interest rates. But what I'm showing you here is at the same time that the Federal Reserve started cutting interest rates to help the banks and the markets, the world market, started jacking us up harshly, and mortgage interest rates went up almost a full percent. So how could the federal funds rate go down 100 basis points, but yet mortgage rates go up 100 basis points? And the reason is because the Federal Reserve is absolutely useless to us mom and pops and has completely lost control. Lost control of what? The 10-year treasury. But here's what I want to show you guys. Mitch made this article. This is 112 pages. Okay, this is going to be linked in the description. The first few pages are all the employees that the Federal Reserve has and how they're wasting money. But what you want to do is you want to go to page 101, which is right here. This is going to be a summary from Mitch. This is gold. This is absolute gold. I don't know how many hours you spent on this, Mitch, but it was a long time. Now, when you go to page 102, he brings up about, I think you said 53, I think it's 53 bullet points. And I want to read a couple of these bullet points, and I want to go back to you, Mitch. Number one, this is a summary. Okay, so the following list of reasons is why the Federal Reserve should be shut down. Number one, we like to think that we have a government of the people, by the people, for the people, because that's what the law says. But the truth is that unelected, unaccountable groups of central planners have far more power over the economy, and I will say also the government, that's me adding that, than anyone else in our society does. Comment below, guys. Let me know whether or not you agree with Mitch on that. Number two, and I'm only going to read four. The Federal Reserve is actually independent of the government. In all caps here, just in case you guys aren't looking. No, it is not. Although the Federal Reserve has argued vehemently, and I had trouble pronouncing that word, Mitch, you got to dumb it down for me a little bit here, brother, in federal court, that it is not an agency of the federal government and therefore not subject to the Freedom of Information Act. Pretty clever. In fact, the Federal Reserve would not exist but for Congress granting its existence. So we can't even audit them. That's very interesting because they're private. Clever government. This mirrors the exact same nonsense where the state of Texas created the taxing entities which own the central appraisal districts, which is like, the schools and stuff like that. So they put us in a corner and we can't do anything about it because they're like, oh, we don't control them. But yeah, you do. Therefore, in both cases, the government, state and federal, are the sponsors of fraud on a mass scale. Comment below. Do you guys agree or not? If no one has the authority to enforce the law, then there is no law, as law must exist to protect both parties of the contract. This is the exact point we are making in the current lawsuit at the Court of Appeals. Great workup, Mitch. Number six, and I'll read one more after this. The Federal Reserve is not an agency, so they claim, see above number two we just read, of the federal government, but it has been given power to regulate our banks and financial institutions. Under no circumstances should this happen because it circumvents normal market conditions, the result of which is inflation at both the federal and local taxing entity levels. Okay, one more, number 35. Let me scroll down here. This is going to be linked. I suggest you guys go back here and share this document to all your state reps, senators, anyone you know in the government, your friends, your family. Send them this document, please. Number 35. Since late 2008, the size of the Federal Reserve balance sheet has grown far less than $1 trillion to more than $4 trillion. This is complete and utter insanity. And just one thing before I get back to Mitch, I wanted to remind you guys, and I want Mitch to respond to this. The Banking Act of 1933, Glass-Steagall. Okay, let me just read this for you guys real quick so you guys understand how we got to where we're at right now. This is the creation of the FDIC, which is also a complete illusion of security and protection. Mitch will explain that in a minute. This is what this says, okay? Back in 1933, we're talking about this act now. The emergency legislation that was passed, see how they're always using emergencies to screw us? Passed within days of Franklin Roosevelt taking office, March of 1933, was just the start of the process to restore confidence in the banking system. Back then, Congress saw the need for substantial reform to the banking system, which eventually came in the Banking Act of 1933 or the Glass-Steagall Act. The bill was designed, listen guys, okay? They even knew back then, 100 years ago, the bill was designed to provide the safer and more effective use of assets of banks to regulate interbank control and to prevent the undue diversion of funds into speculative operations. Well, they found a workaround for that, didn't they? And for other purposes, the measure was sponsored by senators. Essentially, you guys, the FDIC was created. And we are far from stopping banks using funds for speculative operations. Mitch, you can go back into that document a little bit if you wanted to touch anything up. We'll obviously go into the mortgage rates after this, but can you explain why the FDIC and the Federal Reserve are not here for mom and pop? They're not here for us. We, mom and pop, are paying for their fraud and for their decades of mistake. Can you go into the FDIC and the Federal Reserve now?
The FDIC doesn't have the money necessary to do a bailout when things go horribly wrong. Anything over and above what happened in 2008 would, in fact, bankrupt the FDIC. So one of the statements in item number 35, it talks about the Federal Reserve assets on the books being over $4 trillion. Well, in that 112 pages, I actually found off the Federal Reserve website their current balance sheet as of December 26. Those assets held, including mortgage-backed securities, as across all the Federal Reserve banks across the United States, is roughly 7 trillion. So you would say, how's there a gap between 4 trillion and 7 trillion? Well, they up the assets held depending on what it is that they believe is coming down the pipe. Well, all these things, just to give you an idea how out of hand this is, if you believed, for the sake of conversation, that the Federal Reserve should exist to help backstop the banks, you would simply say, okay, if you're going to have that on one hand, then let's put a cap. Yeah, there you go. That's the manipulations of the money moving. So that's inside the document. But then you would simply say, let's have a cap. Well, a reasonable cap for the Federal Reserve to exist, which should only be roughly 50 people to begin with, not 23,000, would be 3% of the gross domestic product. That's reasonable. Okay, that's 750 billion. Please explain the delta between 4 trillion and 7 trillion. You can't. Therefore, the Federal Reserve exists for the sake of the Federal Reserve. It has nothing to do with mom and pop. It has 100% to do with backstopping banks that in truth are bankrupt. The next problem coming down the pipe is the commercial real estate. So the Fed is increasing its holdings of the Treasury based on what it sees or thinks is coming. It's got nothing to do with mom and pop.
One thing I wanted to come back to, and this is on page 108 right here, is the inflation calculator. You've essentially taken what a dollar value was in 1913 compared to 2024, and the cumulative rate of inflation is 3,086%. So $5 back in 1913 would now be worth $159. This is absolutely insane.
Yeah,
It's
and on
absolutely
top of
crazy.
that are two actual graphs that are really good, just showing the absolute destruction of the purchasing power.
This is a horrible situation. I mean, I was hoping that people would just let it crash, which is what we needed, instead of making things worse, more systemic. I mean, we're going to go into the housing market part right now, but I wanted to tell the viewers this, and Mitch, just back me up here or add anything on here. But there's going to be a lot more difference in the upcoming depression or recession versus the global financial crisis, the GFC. During the GFC, arguably all we had was a housing market bubble. Arguably, we had fraud at the highest level as well, and usually it's the fraud. But right now, I want to remind you guys that it's not just the housing market that's broken right now. I believe, in addition to asset prices, stock, housing market prices crashing, and Mitch has helped guide me through this to understand this, but I also believe that there's going to be a massive crash, if you will, in pensions, retirement accounts, and 401ks as a result of how over leveraged things are and how sticky the inflation is. Mitch, before we go into the mortgage interest rates and I show the viewers that stuff and we talk about amortization, can you explain to the viewers why people are at risk of losing their pensions this time as compared to the GFC? What's different this time?
Well, let's go back on the Federal Reserve for a second. The book value is the face value. So they say, well, our mortgage-backed securities are worth X, but that is not the underlying value, nor have any reserves been taken to offset the underlying value. So you have a fraud upon a fraud occurring here. And mom and pop have pensions. School teachers have pensions. We can discuss what the school teachers are doing, et cetera, with regard to the taxes, but they have pensions. And those pensions take their money and then they invest in potentially mortgage-backed securities, or they take their 401ks, they invest in mortgage-backed securities. Either case, they also buy US Treasuries. Well, the US Treasuries are comprised of the implicit guarantee of the US government to be able to pay those off. But we've proven mathematically that can't happen. We've proven mathematically that the average house across the United States owes over 1.3 million between the federal and the local taxing entities' debt that they've created. That's over and above the mortgage on your own house. So you can't pay that off. The vast majority, as in 98% of the public, cannot pay that off. That assumes that by tomorrow morning, you'd have $9,000 of additional income for which you could write a check for the next 25 years. Therefore, mathematically speaking, the debts can't be paid off. And why I keep pounding the table, we're at the tipping point. The fraud is what has put us at this point. The existence of the Federal Reserve is exactly what has put us at this tipping point. The existence, the idea that the real estate taxes should even exist is a fraudulent social construct to begin with, because it's not even allowed under the 16th Amendment of the US Constitution. These two entities, both federal and local, have created these debts that cannot be paid off. And if anybody thinks they can, show me. Give me the math, because you can't. We've run the amortization schedules. We've looked at the balance sheets from top to bottom. I've given them to you in this 112-page document. Those are the balance sheets of the Federal Reserve. The debt load is growing. But the assets that they're holding aren't even the value of the assets that they've claimed as book value. There's no way out of this. Now, it can be worked out. As long, so it's like I said, even with the press, at least state what the possible solutions are. Well, we're stating what the possible solutions are. The Federal Reserve's doors need to be shut down. And find anything that I've said inside of those 53 bullet points and counterclaim it. Go ahead. I'm happy to hear it. I'm thrilled. But you can't, because the facts are the facts, the law is the law, and the math is the math. It all adds to, this is one giant scheme of fraud. They did it to protect the banks since its inception. And as I said before, the Federal Reserve has never been on the right side of a move since the day it was invented, because it didn't exist to protect mom and pop. The real estate taxing entities, which are the school districts in particular that we're taking aim at because they don't have any assets, well, they've done the same thing. Backstop us. You cannot freeze the real estate taxes. You must raise the taxes in perpetuity or we are bankrupt. And I've replied to that, no, you're bankrupt today. So it's the combination of both the federal and the local that has created this fraud that simply cannot be paid back. So here's an idea. Why don't we just recognize what the problem is and deal with it? Start these work downs and workouts so that people can end up with some money on the dollar versus heaven help you if the market moves before everybody else does, because it'll just simply crash. It'll just implode. And once the snowball starts rolling, you can't stop it.
You know, Mitch, there's another side of the coin, isn't there? And that's apathy and the lack of care that some people have. They want to stay in their bubble. They want to keep living the way they're living. And to understand what we're talking about would mean that they would have to stop trusting the government. And a lot of people don't want to go through that pain. A lot of people are not capable, in their minds anyways, of going through that transition. I know when I learned these things, Mitch, it hurt me. I mean, it literally changed my brain chemistry. It took me probably several months to recoup from that. The apathy is an issue. Now, talking about solution, and I really want to get into some mortgage rates here. So let's try to be fast, but I'm going to be honest, man. You know, I'm sitting back here and I think, and I don't, maybe we should talk about this off camera, but another solution here, maybe people remanaging their pensions and 401ks. That may be, to be honest with you, that sounds like a national emergency. I don't want to go into that and step into that too much. I'm not a financial advisor. But it sounds like what we might want to do, and if you guys are listening to this, comment below and let me know whether or not we're on the right track here, is figure out ways for people to possibly, and I got to be careful, redivert their pensions. Because if we're warning people, and I don't have faith in the government, my friends, if we're warning people that pensions are about to be wiped out 40, 50, 60%, then to me, part of that solution in what we're doing here would try to figure out a way to take a risky pension and put it into a less risky investment. What do you think about that?
Well, let's back up for a second. What's the alternative, right? So let's just say, for the sake of conversation, that everything we're presenting is accurate. You now have the knowledge. You, mom and pop, now the viewers have the knowledge that something is horribly wrong. Over and above that, 2 years ago, when the government came out and said, well, we're going to authorize the banks to take your money, your depositors' money, and use it as a bail-in program. And given what the conversation was that we just had, what exactly is your alternative not to get involved and not to trust the government? In other words, if you trust the government, you think this government's going to bail you out, there's a higher probability you're going to end up without a house. You're going to end up without a roof over your head, right? That's where this math is. And we've proven it mathematically again, because you owe, the average homeowner owes $9,000 per month for the next 25 years to cover off their debts. So you see, the problem is the nexus. If the governments allow the bail-in, even though it is law, but let's just say they actually execute the law, well, your money is gone. Your cash is gone. It's now been exchanged for one share of a useless bankrupt bank. So the answer to your question is, what exactly alternative does anybody have out there other than to get involved and understand how this fraud was committed? Again, what's the root cause of the fraud? What's the story? And what's the solution? Well, the solution, Travis, is to your point where you're headed with this, which is you have no choice but to get involved, because if you don't get involved, you're putting yourself, your family, and your neighbors in harm's way. We're at the tipping point. I'm begging anybody out there, maybe all the way down to the schools, give me the information. We'll deal with it. If I'm wrong, show me. If I'm right, then mom and pop, everybody's got to get involved. This is not, you cannot possibly sit here after all these discussions and say, hey, everything's okay, the government's going to look after me. No, they're not. They don't have the money to look after you. Society doesn't have the money to look after you. In Chicago this weekend, the government has now come out and said, well, we're going to start mandating fees for the multifamily owners as a transaction fee on rent. These people are so damn stupid. They literally do not understand that that's a pass-through back to the renters. They're literally hurting the same people that they claimed and that they profess to have their best interest at heart. It simply isn't true. It's a fraud. It's a cash grab. You cannot trust the government, and nor should you.
You know, we'll come back to that, Mitch, but I think, we'll think about this, talk about this more, but I think we got to start thinking about, all right, what's something safe to put? I mean, you put cash, gold. I mean, we'll come back to that. It's a very complicated answer, obviously. And I think
look at it this way. The best answer to your question would be, when I said a few minutes ago, the idea that the Federal Reserve should be capped at 3% of the gross domestic product. Well, that's true. That's an accurate statement. That's what it should be capped at in order not to get the rest of the world in trouble. It's kind of the same thing with mom and pop. If you don't know where your money is invested, be it the pension funds or the 401ks, and you have no idea where that money is going, what do you think it means to you if that money is being put into an investment when that investment is levered 80, 90, 105%? What are the probabilities with that type of leverage that you're going to run into problems? And I will state, I'll surmise that the probabilities are extraordinarily high you're going to run into problems. You may not see it today, but the point is, if it's over levered, you've got a problem. You're better off saying, okay, fine, I'm going to remove this money. Now, of course, you have to be comfortable with looking after the investments, et cetera, but it's kind of the same thing. If you go to your financial advisor and your financial advisor doesn't have a plan for you to be able to either buy puts or sell put spreads against your position to help offset some of these damages should they arise, well, then you better find another financial planner. So, and you better find one who understands that massive debt isn't the answer. Debt that is levered isn't the answer. So if you find an investment where you've got 40 or 50% leverage, let's just say you want to invest in a house and you're putting down 50%, at least it's a house you can handle the mortgage, ideally, whatever it is you're working on. That's okay. 105% on a house, 95% on a house is not okay. You're putting yourself and your family in harm's way. Think of it as the debt load on whatever it is that you're investing in. Now, precious metals, when you buy them, you stick them in the ground somewhere, right? It's a fantastic element. You dig it up out of the ground, you find another hole, and you put it right back in, right? But the point of the matter is it's yours, right? There's no leverage on it. It's yours. If you have a house that's bought and paid for, yes, you're paying the real estate tax, but at least the asset is yours. Either way, all this stuff is about building your personal balance sheet, and the government has proven that they have taken your personal balance sheet by virtue of equity stripping. So it's got to stop. The way you make it stop, eliminate the real estate taxes in favor of a uniform state's sales tax. Now you're on the same playing field as everybody else in the United States. That's the perfect position to be in. So it's a combination of two moves, both of which can be accomplished very quickly.
Well, unfortunately, they're not. Unfortunately, they're not. And unfortunately, the common American right now, it has lots of problems that they're not even aware of. And that's what we're facing. I mean, it's a bad thing. Let's move on to mortgage interest rates. Now, real quick, you guys. So if you want to watch and understand the trajectory of mortgage rates, and this is for you realtors, especially anyone that wants a home, mortgage loan officer, even mortgage loan officers of 10 years don't even know this, but this is what you watch right here, you guys. So this is down today. The 10 year is actually down. The 10-year tracks residential mortgage rates. So what you're going to see is first of all, here's what the mortgage rates are at, 7.11%. However, with this 10-year going down 8 basis points, the market is going to be pricing in, okay, it's called pricing in the reduction of the 10-year. So odds are when this updates later today, probably the rates will be something like 7.05 or 7.0 something. Let me refresh it to see if it's updated. Boom! It's updated 7.06. Okay, so that did update. I was a little bit off by 1 basis point, but you guys see right there. So it just priced it in right now to 7.06%. So again, you guys watch that 10-year. Now, what I really want to hammer down on is there's so many people that were sold on, dating the rate. But the thing is, guys, what they're not explaining is how the rate works. You're actually married to not only just the house, but you're also married to your mortgage. So we don't even have to talk about rates. We could just talk about how a mortgage works. And that's why I have this up here. This is called an amortization schedule. This is worse, in my opinion, than credit card debt. A 30-year fixed rate mortgage is worse than credit card debt. And another thing that's super horrible that people do is they refinance their mortgage for all of the wrong reasons. Now, what I want to start is by talking about the average loan amount. You guys hear me talk about 324 all the time because that's roughly the average. This is on a 30-year loan at today's interest rate. I'll change it. It was 7.06. Let's change that. All right, let me recalculate this. So people are like, if you're renting, you're paying 100% in interest. But people that say that don't understand how amortization schedule works. And they say that to discredit people and to bully people. And it drives me absolutely crazy because they're so filthy wrong. It's disgusting. But right now, you guys, if you have a loan amount of $324,000, you're paying back $780,000. So when you really look at that, it makes, in many cases, especially if it's cheaper to rent, which right now it's substantially cheaper to rent, it makes sense to rent. Because if you don't rent, you're going to be paying, 140% in interest? So just understand, okay, buy a house if you want. But for the love of all that's holy, understand how the financing works. And the financing works to keep you enslaved in debt. If people just paid off their mortgage, banks would go out of business tomorrow. But first thing I want to say is, okay, first of all, you're going to pay a whole bunch of money back. Your true interest rate is usually double this is plus a zero. So 14 plus a zero is 140%. That's a quick way to kind of look at that. But I also want to show you guys that the first year that you're paying your mortgage, $22,770 goes towards interest, but only $3,200 goes towards paying your balance down. But the 29th year, look at this, only $2,600 goes towards your interest and $23,000 goes towards your principal. Unfortunately, it takes 29 years to get there because the way that amortization schedules work is it's front loaded with interest, meaning, as you see here, you pay off your interest before you pay off your principal. All right. So in 5 years, if you pay this loan for 5 years, you've only paid down, look at, you've only got a balance now of $305,181, which means you've only paid down less than $19,000 of your original loan amount. So it takes you 5 years, okay, in this scenario, 5 years to pay down $19,000 of your balance. Are you freaking kidding me? Which also means if you pay down roughly within the first year of your loan, you save 5 years and look at every one of these columns, over $120,000 in interest. It's roughly 120. It could be 110, 120. It varies depending on the interest rate. So if you guys really want to get out of the trap, which is a mortgage, pay your principal down and pay it down early. And I want you to know this, the 140% in interest you're paying is not counting your homeowner's insurance and taxes, guys. When we count your homeowner's insurance, your taxes, and your HOA, it could be 200%. Renting is smart. It's smart for a lot of people right now. It shouldn't be that way. I'm not saying it should. I think we should own a property, but do we really own it if we stop paying our property taxes and the government kicks us out in the street? Do we really own it then? And I want to show you guys one more thing, optional payments. All right. Say every month you pay $500 extra a month. All right. So just stop going to Starbucks and eating out. Actually, if you stop eating out, it'll be $1,000, but let's just say 500. When I calculate, if all you do, you just $500 a month, look at this, guys. Okay. You save, the loan will be paid off instead of 30 years. It will be paid off in 17 years and 10 months. You've almost now turned in your 30 fixed rate mortgage into a 15-year loan. 15-year mortgage, that's what Dave Ramsey loves. Okay. So you don't have to get the 15-year and be locked into that payment. You can actually have a 30-year and be flexible with extra payments. So you put extra $500 to your principal, specifically your principal. Make sure you say that to your lender, or they'll put it potentially in an escrow account, just refund you the money. You save in just interest, guys. Think about what I'm saying. You save not only that time, you also save $210,000 in interest by only paying $500 a month off in your mortgage. So you save the time, you save the interest. I mean, it's a slam dunk, Mitch. You know, I think we discussed a lot. Okay. We discussed a lot. Can you explain, in talking about refinance, because what happens is people, I hate when people do this. It's such a terrible thing. People refinance to pay off $20,000 in credit card debt. What they do by doing that is they start their entire amortization schedule. Say they've been paying their loan for 3 years and they paid $60,000 in interest. Guess what they just did? They started that $60,000 in interest payment, started it all over again. And not only that, they took their $20,000 in revolving credit lines and they've locked it into 30 years. The smart thing to do is, first of all, not get into credit card debt. But if you are in credit card debt, pay the credit card debt off separately. Leave your mortgage alone and pay that sucker down. The sooner you can pay your mortgage off, the better. But people don't do that, Mitch. They say, oh, I have a 7% and oh, now things are 6%. Refinance, automatically refinance if it's 1 point lower. That is a fraud. That is the ultimate scam that will keep you trapped into debt for the rest of your life. You must conquer the system. In order to conquer the system, we must be more responsible with our money, get out of the rat race, and target these mortgages, if we have one, directly and pay that off. So a refinance can be an absolutely devastating thing into the future. But Mitch, can you just talk about anything you want to wrap up, but also talk about under what circumstances would you recommend someone were to refinance their mortgage?
Never. Over and above that, What's the difference between what you just described as somebody wanting to refinance their mortgage to pay off their credit cards versus what the school districts are doing? It's one and the same. School districts are doing it with bonds. They're rolling up and they're rolling out. Well, that's exactly what you just described for mom and pop when they go and pull out a loan to take equity out of their house. They're one in the same. It is a straight up financing fraud. All
That's
you
good.
are doing is setting yourself up for failure. You're not dealing with the problem, right? The problem is you spent too much money. That's the reality. Now the question is, how are you going to get out of what was spent? Not go and, well, double down to failure, because all you're doing is you're extending the problem and it's costing you. That extension is costing you. It literally is no different than what the school districts are doing. It's identical.
I
The
can't
difference
argue with
is the
you.
school districts are using you
Yeah,
to backstop them. You have
Right.
nobody to backstop you.
that's right. You have the street. That's it. The street's going to backstop you. Have fun living on the street, especially if you have a family. Mitch, I did that. I doubled down in 2008. I doubled down on failure. I tell the viewers all the time, I had a foreclosure, a repo, bankruptcy, and $100,000 tax lien. I literally lost everything. But the biggest thing that I lost was my family and myself. And I can't tell you how long it took me to get those things back. But Mitch, this is really good stuff, man. I really appreciate you. I want to go into some housekeeping stuff, and I'm going to give you the last words to close us out. As far as housekeeping, you guys, don't forget, all of our videos are linked with, and these links bring you to a Google Drive file that I make. So if you click the link, it should bring you to that Google Drive, and it should have several documents. I mean, all we have is documents. So go to this. Don't forget to look at the documents. His link is going to be in there with the 112 pages. I think it was 112, right? 112 pages. So that will be there. There'll be other things there. And I always want to remind you guys, I have 2 courses for free that I made for you. One is how to fight property tax. You guys better start taking that. I see who's taking it and who's not taking that. You guys better start taking the property tax course. It's 40 videos, 40 I made for free. I had a nervous breakdown. Also, the home buying course. Every person, including realtors, loan officers, needs to take my course in home buying. It's absolutely free. And when I say home buying, what I'm really saying is understand what it means to buy right. Not emotionally. I know it's emotional, but I'm talking about mathematically what's right, what's wrong, how to shop your mortgage, credit, income, assets. It's all there, you guys. It's all for free. And the reason why we do that is both Mitch and I, and that's why I love Mitch, we care about the community. We literally care about the community. We want to be leaders, showing people you don't have to get filthy rich. You don't have to get rich. You don't have to ask people for money. You could just help. That's it. You can just help. Can you believe that? That's crazy. I'm sorry for the little mid-roll and commercials for YouTube. But you guys, we're trying to help conquer apathy by leading you guys through the fire. And that's the point that we're both trying to make. Also, last thing, and I'm going to give it to Mitch. I got one more video coming out on Hurricane Helene. I'll probably going back in a couple of weeks. I have lost a lot of money. I've spent a lot of money. I'll be doing a community post about that separately. But this next video, you guys, it might be one of the most important videos I made. It's actually about the Irwin Industrial Complex. I'm going to share with you guys now the soil samples, the water samples. I'm going to show you guys that even though I was deadly afraid, I still walked my butt in there, and I handed out roughly 400 masks to the construction workers, and they called the police on me. So that's a very important video. A lot of corruption, a lot of lack of care for human life, and we're going to expose that. Mitch, happy New Year's Eve. Anything else you want to say, brother, before we let the viewers go?
Yes, there's no doubt that the circumstances of Travis reaching out to me that started this whole thing rolling, things have lined up, and for whatever reason, I'm in a position and my company gets hired as part of that position to help mitigate problems for developers or investors before those risks occur. And quite often, unfortunately, we get hired to come in after the fact under crisis management to help mitigate those risks. Well, if we could impart anything to help everybody that's a viewer, simply make them start thinking differently. How do I mitigate the risks of what is going on with regard to my assets? that is probably the best framework from which you can start to think differently. And like I said, all these things are coming together for some strange reason, but the evidence that we're getting from across the United States is what is feeding this. It's our ability to understand, well, risks have to be mitigated. What exactly has the federal government done to mitigate the risks? The Federal Reserve has caused the inflation. They are the purveyor of inflation, as is the local taxing entities, as is the central appraisal districts, which is owned by the local taxing entities. They are the ultimate purveyors of inflation. The consumer price index is the ultimate big lie. You've got to think differently and figure out, how can I mitigate these risks in my life and in my family's life? That is by far the best lens to be looking at this problem through.
Well said, sir. Mitch, it's always an honor to work with you. I'm happy to be back. Sorry I was gone in the field for so long. I've missed you, sir. It's been a minute to adjust back into this, but man, I've missed you, man. And thank you for everything you're doing, Mitch. Also to the viewers, Mitch's email and website will be in the description as well. Obviously, we get slammed with emails, guys, and some of these emails are absolutely heartbreaking. So just bear with us. Keep emailing. Put in the subject line what it's regarding, and be safe out there, guys. Don't fall for the rat trap. Don't be a part of the sheep. Break yourself out. I know it's painful, but it's really important. And actually, life is actually really cool when you're motivated to just help people, just to help people. I know I love doing it. I know it helps my soul. I'm pretty sure it will help yours if you need that help. Now, other than that, guys, if you're out there investing in real estate, investing in the stock market, or just living your life, you guys already know we wish you luck and we hope you win.